Here's a shocking fact that most American seniors don't know. The government quietly changed the rules on inherited IRAs, and now your children could owe $50,000 or more in extra taxes when they inherit your retirement savings. I'm not exaggerating. A recent study found that beneficiaries will pay an average of 30 to 40% more in taxes under these new rules compared to the old system. And the worst part? Most families have no idea this is coming. They think they're leaving their kids a nice inheritance, but instead, they're leaving them a massive tax bill. The IRS is counting on you not knowing about this. They're counting on your family being unprepared. But today, I'm going to show you exactly what changed, how much it could cost your family, and most importantly, what you can do right now to protect your loved ones. Stay with me because this could save you thousands of dollars. Let me explain exactly what changed and why it matters so much to your family. Before 2020, your children could inherit your IRA and stretch the withdrawals over their entire lifetime. This was called the Stretch IRA, and it was a beautiful thing. For example, if your 50-year-old daughter inherited your $500,000 IRA, she could take small withdrawals over 30-plus years, letting most of that money continue growing tax-deferred. She might only need to withdraw $15,000 per year. But Congress passed something called the Secure Act, and everything changed. Now, most non-spouse beneficiaries must empty the entire inherited IRA within just 10 years. That same daughter now has to withdraw $50,000 or more every single year. And here's what makes it devastating. Those withdrawals are taxed as ordinary income. So if your daughter is in her peak earning years, making good money, those forced IRA withdrawals could push her into the 32 or even 37% tax bracket. Let me show you the real numbers so you can see how devastating this is. Say you have a $400,000 traditional IRA that you plan to leave to your son. Under the old stretch rules, he could withdraw about $12,000 per year over his lifetime. At a 22% tax bracket, that's roughly $2,600 in taxes annually. Very manageable. But under the new 10-year rule, he must withdraw $40,000 per year. If he's already earning $80,000 at his job, that extra $40,000 pushes his income to $120,000. Now, parts of that IRA distribution are taxed at 32% instead of 22%. Over 10 years, he could pay an extra $40,000 to $50,000 in federal taxes alone. And don't forget state income taxes. In states like California or New York, add another 5 to 10%. Your son could lose nearly half of his inheritance to taxes. This is money you worked your entire life to save, going straight to the government instead of your family. Now let's talk about solutions because there are real strategies that can protect your family. The first and most powerful strategy is called a Roth conversion. Here's how it works. You take money from your traditional IRA, pay the taxes now at your current rate, and move it into a Roth IRA. When your children inherit that Roth IRA, they still have the 10-year rule, but here's the magic. All withdrawals from an inherited Roth IRA are completely tax-free. Let me repeat that, completely tax-free. Your kids can take out every penny without owing a single dollar to the IRS. Now you might be thinking, but I'll have to pay taxes now. Yes, you will. But consider this. If you're retired and in the 22% bracket, you pay 22% now. If your working children inherit a traditional IRA and they're in the 32% bracket, they pay 32%. By converting, you save your family 10 cents on every dollar. On a $300,000 IRA, that's $30,000 saved. Let me give you the exact steps to execute a Roth conversion properly. Step 1. Contact your IRA custodian. This is the company that holds your retirement account, like Fidelity, Vanguard, Schwab, or your bank. Their phone number is on your statement. Call them and say you want to do a Roth conversion. Step 2. Decide how much to convert. You don't have to convert everything at once. In fact, doing partial conversions over several years is often smarter because it keeps you from jumping into a higher tax bracket. Work with a tax professional to find your sweet spot. Step 3. Complete the paperwork. Your custodian will send you forms. It's usually just a few pages. You'll specify the amount and whether you want taxes withheld. Step 4. Pay the taxes. You can either have taxes withheld from the conversion, or better yet, pay the taxes from a separate non-retirement account. This keeps more money growing in your Roth. The deadline for conversions is December 31st each year, so don't wait until the last minute. Strategy number 2 is strategic withdrawal planning during your own retirement. Many seniors make the mistake of letting their IRAs grow as large as possible, thinking bigger is always better. But here's the problem. Required minimum distributions start at age 73, and if you haven't been taking withdrawals, your RMDs could be huge, pushing you into higher tax brackets and leaving an even bigger tax bomb for your kids. Instead, consider taking extra withdrawals now while you're in a lower bracket. For example, if you're married filing jointly and your taxable income is $60,000, you're in the 22% bracket. That bracket goes up to $89,000. You could withdraw an extra $29,000 from your IRA, stay in the same bracket, and reduce the amount your children will eventually have to withdraw under the 10-year rule. Every dollar you withdraw now at 22% is a dollar your kids won't have to withdraw later at 32%. It's simple math that can save your family thousands. Strategy number 3 involves using qualified charitable distributions, also called QCDs. If you're 70 and a half or older and you give money to charity, this strategy is incredibly powerful. A QCD allows you to transfer up to $105,000 per year directly from your IRA to a qualified charity. The money never counts as income on your tax return. This accomplishes 2 amazing things. First, you get to support causes you care about. Second, every dollar you send to charity is a dollar removed from the inherited IRA tax problem. Let's say you donate $10,000 per year through QCDs. Over 10 years, that's $100,000 removed from your traditional IRA. Your children now have $100,000 less to withdraw under the 10-year rule, potentially saving them $30,000 or more in taxes. To do a QCD, call your IRA custodian and request a direct transfer to your charity. The key word is direct. The check must go straight to the charity, not to you first. Strategy number 4 is life insurance replacement. This might sound unusual, but hear me out because it's brilliant for the right situation. Instead of leaving your entire IRA to your children where it will be heavily taxed, you could use some of that IRA money to pay premiums on a life insurance policy. When you pass away, the life insurance death benefit goes to your children completely income tax-free. Let me show you an example. You have a $500,000 IRA. Instead of leaving it all to your kids, where they might lose $150,000 to taxes, you withdraw $30,000 per year to pay life insurance premiums. After 10 years, your IRA might be down to $250,000, but you've purchased a $400,000 life insurance policy. Your kids inherit $250,000 from the IRA and $400,000 from life insurance. They pay taxes only on the smaller IRA amount, and the $400,000 in life insurance is tax-free. Total inheritance actually goes up while the tax bill goes down. Now let's talk about who is exempt from the 10-year rule, because there are important exceptions. Surviving spouses have the most flexibility. If you leave your IRA to your husband or wife, they can treat it as their own IRA and aren't subject to the 10-year rule at all. Minor children of the account owner are also exempt, but only until they reach the age of majority, usually 18 or 21 depending on the state. Then the 10-year clock starts. Disabled or chronically ill beneficiaries can still use the old stretch IRA rules if they can document their condition properly. Beneficiaries who are not more than 10 years younger than the deceased account owner are also exempt. This often applies to siblings close in age. And here's one more important exception. If you inherited an IRA before January 1st, 2020, the old stretch rules still apply to you. The new 10-year rule only affects IRAs inherited after that date. Know which category your beneficiaries fall into, because it dramatically changes your planning strategy. Now I need to warn you about the biggest mistakes people make with inherited IRAs. Mistake number 1 is ignoring the 10-year deadline. If your beneficiaries don't empty the inherited IRA within 10 years, the IRS will impose a 25% penalty on the amount that should have been withdrawn. That penalty was recently reduced from 50%, but 25% is still devastating. Don't let your kids forget this deadline. Mistake number 2 is taking it all out in year 1. Some beneficiaries think they should just rip off the bandage and withdraw everything immediately. This is almost always wrong because it creates one massive tax bill in a single year. If your child withdraws $400,000 all at once, they could easily owe over $100,000 in federal taxes alone. Spreading withdrawals over 10 years almost always results in lower total taxes. Mistake number 3 is beneficiaries not understanding they still have required minimum distribution rules during those 10 years. The IRS recently clarified that annual RMDs are required if the original owner had already started taking RMDs. Mistake number 4 is failing to update your beneficiary designations. Your IRA doesn't pass through your will. It goes directly to whoever is named on the beneficiary form with your custodian. I've seen situations where someone's ex-spouse from 20 years ago was still listed as beneficiary because they never updated the form. Every 5 years, or after any major life event like marriage, divorce, birth, or death, call your IRA custodian and verify your beneficiary designations. The phone numbers for major custodians are Fidelity at 800-343-3548, Vanguard at 800-662-747, and Schwab at 800-435-4000. Mistake number 5 is not communicating with your children about your plans. If your kids don't know what's coming, they can't plan for it. Have an honest conversation about your retirement accounts, the tax implications, and your strategy. Give them a copy of this video. The more prepared they are, the more money stays in the family instead of going to the IRS. Let's summarize what we've learned today, because this information could save your family $50,000 or more. The Secure Act eliminated stretch IRAs for most beneficiaries, creating a 10-year withdrawal rule that can result in massive tax bills for your children. Your 4 main strategies are Roth conversions to create tax-free inheritances, strategic withdrawals now while you're in lower brackets, qualified charitable distributions if you're 70 and a half or older, and life insurance to replace taxable IRA dollars with tax-free death benefits. Avoid the deadly mistakes of missing deadlines, withdrawing too fast, and forgetting to update beneficiaries. Most importantly, take action now. Don't wait until it's too late. Call your financial advisor or IRA custodian this week. If this video helped you, please hit that subscribe button right now. We release new videos every week about protecting your retirement, maximizing Social Security, and keeping more of your hard-earned money. Next video, I'm covering the Medicare changes coming in 2025 that could affect your wallet. You won't want to miss it.